For about 100 years, the global car industry operated as a highly predictable oligopoly. The names that defined modern driving, Toyota, Volkswagen, Ford, all flowed outward from Germany, Japan, and the United States. But the financial health of these legacy brands has deteriorated rapidly. Porsche's bottom line dropped 92% in a single year, while Stellantis posted a $26 billion loss. While rising interest rates and software delays have hurt their margins, internal reports and investor calls consistently point to one rising competitor, BYD. BYD has expanded its footprint across every continent simultaneously. In Thailand, they captured 40% of the electric vehicle market in 18 months, forcing Mazda and Mitsubishi to slash production. In Brazil, they seized 72% of the EV market, taking over an industrial site Ford had recently abandoned. Their growth model defies traditional automotive economics. This has left the industry trying to determine if BYD has built a superior industrial strategy or a highly leveraged expansion that cannot be sustained. To understand the anomaly, look at their starting line. In 2003, BYD did not build cars. They ran a workshop in Shenzhen making rechargeable batteries for early cell phones. When they decided to buy a bankrupt state-owned car factory, the automotive establishment treated it as a punchline. When asked about BYD competing with Tesla on live television, Elon Musk couldn't hold back a laugh. But their complete lack of automotive experience forced a unique engineering approach. While legacy automakers were trying to figure out how to electrify an existing car chassis, BYD simply built a car around a battery they already knew how to mass produce. The architect behind that approach is Wang Tuanfu.
He was an engineer who borrowed money to start a battery company, then infuriated his own investors by pouring that cash into a dead automotive plant in the middle of nowhere. This diagram maps out a traditional automotive supply chain on the left, relying on hundreds of external vendors, against BYD's model on the right. Volkswagen and Toyota outsourced their chips, electronics, and glass. BYD decided to build everything internally. They produce their own semiconductors, their own motors, and write the software running inside the dashboard. They carried this vertical integration all the way down to the dirt. To insulate themselves from volatile commodity prices, they started mining their own lithium in Tibet and South America. When the global chip shortage and lithium price spikes paralyzed Western automakers in 2021, BYD simply dialed up its internal production. Every macroeconomic crisis that stalled the competition became an accelerant for BYD. They secured domestic dominance by ignoring the Silicon Valley obsession with pure electric vehicles. Instead, they scaled up using plug-in hybrids and a cheaper, highly stable lithium iron phosphate battery, capturing the massive Chinese middle class. But smart engineering only explains part of the math. To execute this kind of global takeover, you need capital at a scale markets rarely provide. BYD had the full backing of a sovereign state.
Under a national industrial strategy known as Made in China 2025, Beijing designated the automotive sector for global dominance. Between 2015 and 2020, BYD collected roughly $4.3 billion in direct subsidies. They received free land for factories, zero-interest loans from state-owned banks, and guaranteed municipal contracts. The state even handed subsidies directly to domestic car buyers. Every BYD sold in China was essentially pre-discounted by the government. At its peak, analysts estimate BYD was pocketing thousands of dollars of public money per vehicle. This allowed them to sell below their actual production cost for years, while still officially reporting a profit. Companies like Mercedes and Ford now face a rival backed by sovereign industrial capital, operating on a logic that prioritizes market capture over immediate profitability. Now that Beijing has largely completed its objective and is winding down those aggressive subsidies, the math holding BYD together is starting to look strained. This chart compares BYD's officially reported liabilities to independent estimates. Earlier this year, a financial research firm out of Hong Kong analyzed BYD's books. While the company officially reports around 42 billion yuan in debt, the report concluded their true obligations are closer to 323 billion, almost 8 times higher. To explain the gap, we have to define a practice called supply chain financing. Instead of borrowing cash from a bank, BYD simply delays paying the people who make its parts. In an industry where the standard payment window is 50 days, BYD waits an average of 275 days after delivery to pay its vendors.
By using their own suppliers as an unpaid bank, they keep massive debts entirely off their official balance sheet. It is a scale of financial engineering that closely mirrors the practices used in the Chinese real estate sector right before the Evergrande collapse. The strain of maintaining this hypergrowth is also leaking into their physical operations. To meet relentless monthly sales targets, dealerships are registering thousands of brand new cars to shell companies they control, then immediately relisting them as zero-mileage used cars. On paper, those count as official sales. In reality, they end up parked and rotting in empty fields across the country. They were never actually purchased by a human being. Pushing production at this speed has immense physical costs. Last year, BYD issued its largest ever recall for steering column defects linked to spontaneous fires, and then immediately had to issue another massive recall a month later. In Brazil, the Labor Ministry even prosecuted the company for subjecting workers to extreme 14-hour days with confiscated passports at a factory construction site. BYD is undeniably selling massive volumes of vehicles, but the foundation beneath those numbers is heavily subsidized and highly leveraged. Whether they stabilize and become a fixture of the global industry or buckle under their own hidden liabilities, their playbook is a direct warning to the rest of the global economy.